Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. What do I look to accomplish in our podcast, especially today? I look to distill the best practices and best ideas of among the world's most successful investors, families, and single-family offices. I hope to provide thought-provoking opinions and feature amazing guests that are true thought leaders to our audience with an eye towards the future of successful investors, families, and their family offices. We have a very special guest. Usually when their name makes it into my title, that probably is a good sign. So we're calling this one Raoul Pal, Global Macro Investor, leading investment strategist, traveler, and rum drinker. We do not want to forget about that. On the greatest asymmetrical trade in decades. Now, I do ask, we're going to get to that a little bit more midway, I would say, because we want to build a little bit of momentum and lay the groundwork. It features our special guest, Raoul Pal, Goldman alum, retired macro hedge fund manager. I might add at 36, very jealous. Co-founder of Real Vision, which probably keeps him more busy now than anything else before. As I noted, he's a former hedge fund manager, retiring early at 36. Raoul is co-founder of Real Vision, a financial media company offering in-depth video interviews. I'm under pressure from a real professional today, and research publications from the world's best investors. He has run a successful global macro hedge fund, co-managed Goldman Sachs hedge fund sales business in equities and equity derivatives in Europe, and helped design the BBC TV program $1 Million Traders, training participants in investment and risk management strategy. Raoul retired from managing client money and now lives in the Cayman Islands, where he is today, where he manages primarily Real Vision. Raoul, welcome to the show.
Great to be here. Thank you for having me.
Well, since I really turned my attention to a lot of issues relative to global issues, to macro, to understanding the nuances of how it all plays together, I don't know if there's anyone that I've been as excited to have on as you. I love your Twitter reads. Real Vision is simply amazing. And really, it's an honor. And some of the great traders that you worked with over the years, and I've been fortunate to have interviewed some of them, just, they're the best of the best. But why don't we get right to it? Why don't we lay a little bit of a foundation? Last year, after mounting for decades, U.S. debt to the rest of the world surpassed 50% of its economic output. I think we all know that potentially could be a recipe for disaster or a coming crisis, which is what I would call disaster. Now, looking back in history, before the U.S., I would say 5 powers going back to what the 1400s really were the reserve currency of the world: Portugal, Spain, the Netherlands, France, Britain, and then us. We're about that 100-year cycle now. What are we in for here in the U.S. with the U.S. dollar?
That's a good question. The US dollar is so dominant right now. US GDP is 25% of world GDP. The number of transactions globally as a percentage of all trade is 80% in dollars. So the dollar is everything. So I don't think the dollar can be supplanted quickly, but by a process of fiat currency debasement by excessive printing, a process of mounting debts, and then what's going on with the central banks and their move towards central bank digital currencies and splitting the world probably into trading blocks, I think is most likely. So I think over time, the dollar will be forced to have a lower percentage of the global payments market and get closer to where its GDP is. And that would be a huge shift.
I would agree. And I would say from the $1 billion single family offices I talk to, they have long-term concerns about the dollar, some shorter term, but things aren't going to flip immediately. Once the rest of the world starts to lose confidence, which arguably to some degree has happened in the US, the dollar and treasuries, and our ability, quote unquote, to pay our bills, then the real, it may hit, quote unquote, hit the fan. But then, okay, what's going to be, and you kind of mentioned it, but a contender? I mean, really, is it going to be the Chinese renminbi? Is it going to be the euro? I can't imagine. Maybe Bitcoin. We'll get a little bit more of that to later. But I would propose, this is maybe a little out of left field, how about a basket of SDR or currency? Kind of a little bit of an inner secret of the IMF.
Yeah, I mean, I think that's coming. And I think they're laying the groundworks by this central bank digital currencies that I alluded to before. Facebook and their project Libra basically opened the door to all of this. Facebook said, we want to start this digital currency payment system, and we're going to do it a little bit differently. We're going to have a basket of currencies that includes the US dollar, right? Everything we know of is everything versus the US dollar, dollar euro, dollar pound, dollar Aussie, or a mixture between those, but we never have the dollar in the basket. If you do, you take out the denominator. So what becomes the denominator? It's probably global money supply. So you end up with something very stable. And you can create baskets that are more suitable for different countries. So Brazilians and South Africans and Argentinians and all of these commodity exporters don't want to have the dollar going up and down, ruining their entire budget balances every time or destroying their companies. What they want is something stable that has value. And as China and others have become larger consumers of the world's goods, it's kind of weird for somebody to sell oil from Saudi Arabia and sell it to the Chinese and get US dollars. So somewhere within this, I think your idea of SDRs based around this new digital currency technology is probably where it's going. And I think it will be regional as well as a global version. So I don't know, it's a fascinating time, and it's going to be a huge change coming.
I'm actually glad that you brought up Libra, which is now called Diem. That was on my list to bring up a little bit later, but we'll jump a little bit into it. So Facebook, Libra got shot down. They readapted, and a lot of people thought they were just going to kind of quietly go away. It did not, which I find very interesting. And just think that Facebook touches what, 2.6 billion? I mean, maybe I'm a little off. That's a threat to, I think, how central banks and governments think of their control of the money. I'm very intrigued. We may get to stable coins and things like that a little bit later. Really intrigued by how this could play out. I mean, the world is changing right before our eyes. Some of it's a little scary, and some of it I'm not so sure is interesting and good.
Yeah, I mean, look, I think that Facebook has a global network effect and one of the largest networks in the world. And we've all got relatives in different countries that we would like to send money to. We buy goods in different countries. And that's a very clunky system. You put in your credit card, blah, blah, blah. Now, if you can have your wallet on Facebook and I could send you money instantaneously, well, that's super empowering. All of the remittances and all of that stuff that happens across the world. Also, if I'm buying something from China, the Chinese don't have to have a US dollar bank account because that becomes a problem. Or if Facebook got their Libra project off the ground, which is the multi-currency basket, then it allows everybody to price goods in a more stable currency. It's very disruptive. I think in the end, the central banks will allow it, because what they need to own is the on-ramps and off-ramps. As long as there's KYC and AML going on, the on-ramps and off-ramps into the system is the super important thing, because they need to collect taxes. So I think there's going to be more regulation coming. It's going to get pretty scary, but the regulation will allow for full adoption.
I mean, let's go back a little bit to the kind of the monetary policy. The QE process in 2008 was mainly to kind of recapitalize the banks, and very different now with COVID and some of the challenges we've been having in 2020. We're pretty much in the midst of what most consider modern monetary policy. Print, 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 more money, more money, more money. Quantitative easing plus fiscal stimulus equals, again, more money printing. I guess short term, this could work, but eventually the rubber's going to hit the road.
We don't know. We don't know where it's going to hit the road and how it's going to hit the road. Normally speaking, so if you look at MMT, modern monetary theory as a school of thought, what I feel that it falls short on is it assumes a closed economy. And the open economy side is the exchange rate. Now, the IMF talked about this. They said, we think everybody who might want to be part of this basket, or a new Bretton Woods, as they talked about, we should allow everybody to print at the same time by the same amount of percentage of GDP, so it doesn't impact currencies. It does impact currencies. They go down versus hard assets, but not via variable assets, corn, wheat, human capital, i.e. wages. They all can deflate while these hard assets inflate. So I don't know what the end game looks like, but the end game certainly looks like hard assets going much higher in price. And family offices, I've been speaking to them about this for a long time. They kind of intrinsically understand this more than others, is wealth preservation is going to be crucial within this.
For sure. I'm going to ask you something completely crazy. You could laugh and blow it off. It's meant to be only a little tongue in cheek, but a little bit of seriousness to it. Relative to what I just noted about quantitative easing, about the challenges of COVID, so many people unemployed here in the US, small businesses going under. Really a lot of challenges. Hell, we already have a huge deficit. Potentially there may be, and we're still the dollar. That may change in terms of the world's currency, but in the immediate future, the answer is no. Would it be completely crazy, hard for me to say this, I'm a libertarian, to give every citizen a significant amount of money? I'm not talking a couple of $1,000 stimulus, $500,000. Okay, let me dumb that down. 50,000. Imagine the money that would go into the stock market. Yes, it would cause inflation, I guess, with real estate. If it does it with food and staples, that could be a problem. And again, I mean this question, what we say in the US, it's out of left field. I don't know if it's totally crazy. What do you think?
I don't think it's totally crazy either. It's basically universal basic income or a cash injection version of it.
On steroids.
Yeah. So, what happens? What's the mechanism by which that happens? So if you give it to everybody, which feels a bit silly because there's a whole bunch of people who don't need it and there's a whole bunch of people who really need it. But let's assume you give it to everybody. What happens? My guess is, firstly, not what everybody thinks. Because Japan has done this and it gave vouchers that had a limited time horizon for people to spend the vouchers. So they gave vouchers to people, free money, helicopter money, and said, you have to spend this within 60 or 90 days. The Japanese, scarred from recent experiences and knowing that they had to repair balance sheet, saved the vouchers and never spent them, even though they expired, which is extraordinary. But that's the kind of behavioral element of what's going on. So I think more of this would be saved than people expect because there's too many boomers going into retirement with not enough money. So for them, that's, oh my God, this is a gift. So I think that helps. Yes, it does drive up prices of certain goods. People will go out and buy a bunch of stuff. We've seen basically this in the Cayman Islands because they allow people to take out 25% of their pensions. So what did they do? Yeah, the watch store sold a bunch of Rolexes because some people just went and bought what they wanted. Really what it did was drive the property market. People had a deposit. That was super interesting. So it's, it didn't, I don't think people went out and bought more food. People who needed money for food, they felt secure, but actually let people get into the property rung because actually the hard part is not paying the mortgage these days because interest rates are so low. The hard part is having the capital to get the mortgage. So, I think it probably has intended consequences and unintended consequences. I'm not sure how inflationary it is because it's a one-off. So the following year it just rolls off, and we've seen that a number of times in Japan. But maybe it kickstarts the millennials into the property market. That's interesting. And that might help many people.
Yes, it is. It's funny that you bring up watches. I am going to maybe bring up collectibles later. I would skew, nothing wrong with Rolex, but FP Jordan, by the way, just my opinion.
I'm just a Rolex person.
So. Oh yeah, no, only a Rolex person. The stimulus. I mean, again, a libertarian, it's hard for me to swallow, but I guess we had to do it. And I think you're quoted on record, pardon me if I'm a little off, but the Federal Reserve, I mean, they stopped the credit markets from imploding, and imagine what that could have done to pensions and much more. So I'm going to use the word, you were a fan. Was it enough? No. And that led to my other question about give people 50,000 or more.
Yeah, look, it's not enough because the banking system got in the way. Velocity of money's so low that money is not going into the hands of the people who need it right now. So small businesses are basically shut across the United States and in Europe, and they don't have any financial help. The Federal Reserve, in terms of printing, did enough. They backstopped the credit market, which was incredibly important. I'd laid out in the past the doom loop. Had they not done it, they were going to set off a complete bust of the pension system. Right. Now, considering the 76 million baby boomers trying to retire, average age of 67 years old right now, that would have been catastrophic. So they did the right thing, but what they've done, the unintended consequence, meant that credit markets now don't give any pricing signal. So you've got something called jump to default risk happening, which is a company, bonds don't price in risk, and suddenly a company goes bust and the bonds go to zero immediately. And we've never seen that before. So there's intended consequences and unintended. They saved the system, they screwed up the pricing mechanism.
Let's go back. I believe the year is 1944, Bretton Woods, where, beautiful hotel in New Hampshire, for those that don't know. I have Jim Rickards coming on in a couple of weeks, and Jim has spoken at some of my events before, and he's going to talk about some nefarious things that went on, arguably with spying and all that, but I won't bother you with that. I think you're familiar with it to some degree, but talk a little bit about Bretton Woods, 1944, maybe I'm a little off, what that did. And really that was the birth of what? The United Nations, the IMF, and then eventually a couple of decades later in 71, getting off the gold standard. And here we are now. So give us the history of kind of money in the last 80 years and try to keep it 2 or 3 minutes.
Yeah, so the 1930s is where it all started. Over that recession period, Germany ran into huge financial problems. They were being forced to pay back war reparations. They couldn't afford to do it. It ended up putting their printing presses. They got into hyperinflation. So they left their gold standard. It started then spreading around the world where people were getting forced off the gold standard. It started getting really complicated. World War II comes along. Everybody ends up depegging, repegging. So Bretton Woods, everybody gets together and says, okay, we've destroyed the world system and we have a chance to rebuild it. Kind of like this situation that COVID may be placing in a different way. So there was 2 schools of thought. John Maynard Keynes, the famous English economist, said that they should create Bancor, which would be a global currency, which is what we've just been talking about, you and I.
Yes.
And then a version of it. But what was agreed upon was the US was going to peg itself to gold and everybody else would peg itself to the US dollar. So it became a dollar world. And that created huge stability. And this massive boom took place after Bretton Woods, and then the IMF, the United Nations, the World Health Organization, they all came, the BIS, they all came one after the other. The rules-based global order system got built. The first crack appeared when Nixon decided that the dollar was too strong and essentially had to decouple from gold. Normally in the past, you would have just decoupled it and repegged it at a different price. That's happened over history all the time. But instead, they just depegged. And that because the world was on a dollar standard, everybody depegged. And that was the rise of fiat currency. And that meant that governments and central banks didn't have to adhere to the gold in their reserves. They could basically print money. Cut to a massive credit boom that came out of it, and additionally, new forms of monetary policy. That eventually, via the deregulation of the Thatcher-Reagan years and empowering of people to be able to take debt, we saw the financialization of the global economy, which peaked in 2007, and then we saw, and still paying for the backside of all of that.
And do you think it would have, hindsight's 2020, but there was kind of 2 main things that were debated during Bretton Woods. And we look to do, I hope to do an event there actually this summer and bring in some tremendous thought leaders and really go back in history and the past and the future of money, I guess you could say. But imagine if Keynes won the argument, the other side. How do you think things would have turned out? It's an impossible question to answer, but I'll ask you anyway.
I don't know. It might have created a stable global system that didn't have the imbalances that a freely floating currency system creates. It used to correct imbalances, but ended up creating more. So I don't know. I don't think there's a perfect solution anywhere. That's why I'm inherently interested in Bitcoin and inherently interested in gold, because they're not tied to central banks or governments. And that
Well, let's segue a little bit into at least part of that discussion. And I think it's a really important one for us today. I'll ask you a broad question, then we'll dive into it. Are we heading to a central bank digital currency?
We are going to a group of central bank digital currencies, a grouping of different currencies together in baskets. Do we go to a bancor, a global currency? I don't think yet, but it's possible in due course. But I'm flagging to people that what is coming and what the IMF and the BIS and the ECB and the BOJ and the PBOC and everybody is telling you is we're about to see the biggest change to monetary, fiscal, central banking policy and currency markets since Nixon left the gold standard. This is that order of magnitude is coming.
So let's learn a little bit about what the Chinese are doing with their little bit of a head start, I guess you could say, on the central bank digital currency. Looking at it from afar, and again, being someone who's concerned about privacy and freedoms, being libertarian, but I have to admit, incredibly efficient from a taxing perspective to just so many different ways. But the blockchain and a centralized network, not like Bitcoin, they see everything. Suppose they take your money. Suppose they freeze your account. Suppose you can't travel. Now that's China. That's a communist country. Is that going to happen with the other central bank digital currencies coming?
Well, Angelo, that is the world we live in now. The US government knows every penny that goes in and out of your bank account, every single asset that you own, what car you drive, everything. They know where you go on holiday. They know every credit card statement, everything. They can do that now. So I think it's a false narrative that something's going to change. What changes with digital currencies is the ability to create individual monetary and fiscal policy. And that leads to the rise of behavioral incentives. And this is where China is going. And this is where they will all go, whether we like it or not. So they can say, Angelo, normally they would say, we caught you driving 10 miles an hour over the speed limit. I'm going to give you a fine. Now they can say, we've taken the money out of your wallet. Okay, is that any different? No. Can you have a claim back? I'm sure you can. But they can give you incentives to do things that they want. We will give you money if you do X. We will take it away if you don't do Y. That's what China is starting to do. That's what is coming. And it's the rise of behavioral economics, big data sets, and instant digital world.
Do you think it's possible that we could do it in a way that would maybe be somewhat less intrusive? And I say we, I mean in the US with the Fed. Is it possible to have such a quote unquote a currency, but it's on the blockchain, but it's backed by maybe not just Bitcoin, but Bitcoin, gold, and silver?
I don't
partially
think the Federal Reserve won't do that because they want to own the currency and the right to debase it. So that's it's crucial to the function and power of government. It's not crucial for us as savers, but it's crucial for their power. And those are the networks that we're dealing with. So they're never going to do that. There's nothing to stop you as an individual, like all of us have, only a bit of Bitcoin, only a bit of gold, only a bit of silver. Now you've got your own private reserve currency. Nothing wrong with that. That's not going to be made illegal. That is a very sensible way to view the world.
Now, is it possible that it could be done on what I would call a public and a private partnership? You're probably familiar with the company Circle. They're doing incredible things. And infrastructure like the Ethereum network. I mean, there are some things in place where maybe we don't quite have to be, we, the US, as intrusive as it looks like what the Chinese are doing to their citizens.
I imagine the US will be less intrusive just because they know the nature of the US and its very strong attitudes towards personal freedoms, which is less strong, let's say, in Europe, and even less strong when you get to Asia. Different societies value different attributes. Asian society is more societal overall. So I hear talk, and I was just speaking to Mike Novogratz just now about this as well. I hear talk that the central bank will own the frontline pipes, but they can use the existing stablecoin network and infrastructure like USDC to use that as the stablecoin. So they don't even have to have a Fed coin. That makes sense. I would understand that because it's been robustly tested, because you know how aggressive markets are in testing technologies. They will break it if they can, particularly in this kind of crypto world. So maybe that's what happens.
And let's transition a little bit. We had a great question come in, Jim, who's a friend and a member, that's going to weave into part of our conversation in about 10 or 15 more minutes. Let me ask you about inflation and deflation. I think we've been fighting deflation for relatively a while. Inflation ran crazy in the US in the 40s and the 70s, but equities acted differently. In the 40s, equities were great. In the 70s, horrific. We've been talking about inflation, and I know the government could manipulate some of the statistics, but are we really on the cusp, even with all this money printing?
I don't think so. I think we've seen it in Japan, and the issue is, we'll come on to definitions of inflation, but with an aging population that is all about to spend less incrementally each year because they've retired and they have their fixed savings, it is almost impossible to generate inflation. It's almost impossible to generate inflation when the entire millennial population has student debt. They have to pay that before they can start spending. So I think at a structural level, it's impossible to generate inflation. You then have globalization and technology, both of which are massively deflationary forces. Globalization means labor arbitrage. And we're seeing that textiles industry is now moving to Ethiopia because they've got a labor force that's able to do it cheap enough and the right infrastructure. And technology is massively deflationary because it's basically replacing humans and any non-productive or less productive form of capacity. So we've got these massive super forces. And if we look at wages in inflation adjusted terms, since 1974, they're flat. Wages haven't gone up. People haven't got richer. What's happened is fixed assets have gone up. And that's because of the printing of central banks. And the household balance sheets have taken on debt to offset the fact that their wages didn't go up and these other assets went up. So I think we can see fixed asset or fixed supply assets inflating in price, which is actually currency deflating in value. And we can still see generalized deflation and no pricing power by humans or corporations as a standard.
So, and we're going to get to asset classes and investing very, very shortly. I mean, I guess we were all trained in inflationary environments, which I agree, talking about it, but it doesn't appear to be happening. Gold, silver, land, and other quote unquote hard assets. But during a deflationary environment, I would think of treasuries, utility stocks, and perhaps although arguably overvalued, the technology companies for the reason that you noted. Is that traditional line of thinking? If we think it's going to be deflationary,
so think of the world, and I'm just developing my thoughts on this. Think of the world in terms of fixed supply assets, variable supply assets. Things with variable supply, stuff you can make more of, oil, television sets, human beings, those are not going to see inflation. Things that you cannot create more of, Bitcoin, gold, you can't change the supply significantly. Gold, Bitcoin, trophy real estate, collectibles, they continue to go up in price. So it's a bifurcated world.
The family offices wanted me to ask you your opinion, and we have a fair amount of things to cover. So we'll breeze through it a little bit quickly, but effectively looking at the world now, and we're knowing with the money printing, with arguably deflationary forces, the reasons that you noted, I guess I could say one little advantage to the US compared to many other larger or developed countries is our age population relative to Japan, China, others in Europe is actually not too bad. But our limits now on immigration, all that may impact that looking 5, 10, 20 years down the road. That's just a sidebar. Let me get to the asset classes. Broadly, let's start with equities. So what's your opinion? The general feeling among families may be an interesting time finally for emerging markets.
If the dollar rolls over, or when it rolls over, emerging markets are the traditional investment class trade that you want to do very meaningfully and just go to the beach for 10 years. because when they go, because they're less liquid than developed markets. If you think of $1 trillion comes out of the S&P 500 and goes into emerging markets, the liquidity and the size means they go up a lot. So that trade is setting up very soon. And I'm not a short-term guy. My view is I want to be in that trade probably sometime later in 2021. I think we've got maybe another stumble before a false dawn, and then we have a setback as the global economy is weaker than expected in the first quarter and second quarter, maybe because of what's going on right now with the virus. Then I think we get the opportunity. And if the dollar starts to weaken, then it becomes very interesting for 10 years.
And family offices are different. They may go through talented managers, separately managed accounts, but broadly speaking, many would access from an ETF. But ETFs broadly in EM have a lot of China exposure. Would you recommend, depending on being very, very tactical, to country-specific ETFs in EM markets?
Well, look, I think at top level, just buy the emerging market ETF. The chart alone is fantastic. So what we're doing here is we're saying, well, emerging markets good, China not good. Well, normally when everybody tells you the same thing, it probably means that China is a good investment. And so I'm kind of interested. I look at the chart of China, I'm thinking, maybe this does really well because nobody thinks it does. So I would do that. If you would then want to dig in, I say, well, the best emerging market story on earth, which is liquid, is India. It also happens to be not cheap, but it's a phenomenal story. Then you've got other stories around the Indian Ocean of really exciting developments, whether it's Saudi. If you're a non-US family office, Iran is probably the best risk-reward opportunity in the world equity markets right now. Mm-hmm. And then, so you've got these young population countries around the Indian Ocean, and those are really, really interesting. Places like Indonesia, places like the Middle East, up as north as Iran, far across as Morocco. They're very investable and super interesting. Also, I think, Taiwan, South Korea, they will continue to perform. And Latin America, it'll eventually turn around again and there'll be great opportunities again. I prefer these young demographic population countries.
One of the family offices wanted to ask me your opinion about Japan.
Japan, when the central bank is buying the equity market, larger than any other participants, and they're printing money, and they're changing their productivity by introducing robots into an aging population. Japan is interesting to me. I think it performs. Is it a real performance, or is it to do with the factors of debasement of currency and the fact that they're buying their own equity market? I think there are better stories. But I don't think it's a bad story.
Some people would we'll turn our attention a little bit to Treasuries, the bond markets. I recently did a survey with my families, anonymous, and like a lot of institutional investors, when you add up the cash and their Treasuries, their bonds, it's, like 28 to 30%. It's a lot. And now, if you're arguing a deflationary environment, maybe not so bad. Inflation, it's horrific. So do you look at things like the 10-year Treasury minus inflation? That's the real rate of return. From a family office perspective, what direction would you head? And I know it's too broad of a question, depends on the family, more or less bonds.
I own bonds, and I think bond yields go lower. I still think they will end up. The US is the outlier right now. Australia just hit zero or negative last night. Most of Europe is now negative, and that's every single country. And that's including Denmark and Sweden, and everybody else went negative. I think the US is the massive outlier, and I think the chances are that the US bond yields go down towards zero as well. So I think there's capital gains opportunities. That's decent. Mm-hmm. And then after that final push lower in yields, if it comes, you want to start reducing your fixed income exposure and looking for a more balanced approach. Maybe you reduce it a bit, but increase something like Bitcoin or gold or emerging markets at the other end of the risk curve to just give you some real juice if the reflation environment comes back. but you always want to have some cash on hand. Liquidity in the end is the most important thing of all.
And let's turn our attention to another real asset, and a common one, if I could call it an alternative in many family office portfolios, and that's real estate. COVID, tremendously impactful. Our big cities are being impacted, arguably not forever, although there are some changes that do appear, arguably some to be permanent. But I'm going to let me try to be a little positive. There may be distressed opportunities if you're a long-term investor. And I would have to think that industrial, storage, data centers, e-commerce, fulfillment centers, there is potential here.
There's potential all over the place as the structure of society changes and what happens. So, I was talking to some of the big municipalities in Canada, talking about, well, they need to take advantage up in Alberta, northern Alberta, of maybe using all of that excess land, to build data centers and Bitcoin mining rigs and all of this stuff, because they've got free electricity and cold air. Now, the cities like New York City, well, there's going to be Miami and other places, there's going to be a huge holing out of that retail areas, but it's going to change hands because young people will be able to afford the rent and they will start new things, new types of stores, new opportunities, new restaurants, new bars. So it will come back. It might come back at a lower rate to start with, but it will rejuvenate everything. The other thing is, when we think about the supply and demand for housing, we've got a mismatch. The boomers own two bigger houses for them, and you can see it. My wife's family live in rural New Jersey. There's these like 7-bedroom Victorian houses that are like $500,000 because nobody wants them. And they're only an hour from New York City, but nobody wants them. Meanwhile, try and find a lower priced apartment in Austin, LA, Brooklyn, and the price is being bid up by the highest paid millennial because there's so many of them. So it's leaving all the rest of the millennials unable to buy property. Meanwhile, all this other stuff. So in Brooklyn, the apartment that the millennial wants to buy, the 2-bed apartment in Brooklyn, is like $2 million. Meanwhile, if they just got on the train, they could buy a house on 3 acres with 5 bedrooms for $500,000. So there will be some structural shifts as people will start to take advantage of different things. So I don't know how it plays out for property. It's complicated.
And very hot right now with single family offices is SPACs. What do you think?
I don't know why they're so hot. For me, it's just it's a IPO through the back door that pays the SPAC holder enormous amounts of fees. I get it.
So then a family office should start a SPAC. It's a good money-making initiative.
Well, if they have stakes in direct businesses, roll them up and sell them off as a SPAC. I don't really get the SPAC excitement. It just feels like an arbitrage between venture capital, private equity, and listed markets. So if you understand that at various points, so pre-WeWork, before that blew up, the private markets were trading at a premium to the public markets. That flipped around. So you're seeing now like IPOs today of Uber. Was it Uber? No, who came out today? Whichever one it came out today. And yesterday, they explode higher, which means that the public markets are now higher. SPACs are a way of taking private equity or VC vehicles and jamming them into the public markets to take advantage of the difference in pricing.
Yeah, that was Airbnb, but very true. And I am going to ask you about the greatest asymmetric trade you've seen. My next question after this one, but there's one or two that some of my more younger millennial family and CIOs have turned their attention to actually in the public markets and have done very well. A little controversial, but it's meant to be with publicly listed pharmaceutical companies doing medical grade, nothing to do with recreational. And no, it's not cannabis, it's psychedelics. Is that something as a niche asymmetric trade that you looked into?
I've heard a lot about it. Tim Ferriss, who I've been on his podcast and he's been on Real Vision, has been pioneering that. And I understand the medical breakthroughs. And I think it's very interesting. And there's a lot of very smart people who I trust have spent a lot of time on the science side of this. So I think it's real. I think we still don't understand much of the effects of the human mind and how to do things. I think there's probably something tremendously big in this. So yes, it's much like the medical marijuana industry as well. It's interesting as well, although I think more overhyped. I think this side of things, much more interesting.
Okay, it's time, Raoul. We've been building it up for about 40 minutes. You're someone who's incredibly intelligent, has been active in the macro community for decades, knows people like Tudor Jones, Drunken Miller, all the big players, John Burbank, Moorhead, I could go on and on. What is the greatest asymmetrical trade that you've seen in decades?
Well, we see asymmetric trades. You just mentioned one. It may be in the pharmaceutical space around certain compounds, stuff like that. That's not what I do. I look at assets. And there's sometimes you can make asymmetric trades in the bond market. You can trade options and you get this big move because the Fed are cutting rates. You can make some good money. I've seen in my career some stock markets go up 10x, sometimes 12x. I've seen some emerging markets maybe go up 15x over a period of 10 years. But we now have an asset that is based around Metcalfe's law, which is the adoption of networks. That is an entire asset in its own right, that the more it adopts is the faster it goes up in price. And that's Bitcoin. Bitcoin, not only does it have upside, but it has potential upside for next year alone of 10x. We don't get that in asset prices. My guess is Bitcoin, and I'll come on to why, will probably get to somewhere north of 150,000, maybe 200,000, maybe 250 in the next 12 to 18 months. There has never been an asset that has performed as well as Bitcoin. It's the best performing asset in all recorded history, the best recorded asset in the last 5 years, the best performing asset in the last 2 years, the best performing asset year to date. Its ability to outperform everything else because it is not only an absolutely immaculate store of value, but it also has the network effects, Metcalfe's law, attached to it, where its technological advantages and its use case is vast. So if I'm looking as a family office and I'm thinking, okay, what is the one bet I should add to my portfolio? There is a chance that this thing goes up 25 to 50x in the next 5 or 6 years, which there is nothing else like it. No real estate, no anything else that you can find as an asset. Now, what is very exciting is that the last time we all got excited about Bitcoin, it was a bunch of retail traders. This time, it's Paul Tudor Jones, it's Stan Druckenmiller, it's Rick Reeder from BlackRock, it's BlackRock themselves. Today, Washington Mass Mutual, one of the big insurance company. There's MicroStrategies, there's PayPal adopting it, there's Square adopting it. It is literally endless now. Who is buying this? It is becoming institutionalized. And if you think of the sheer amount of institutional capital out there, the insurance industry alone, and there's 2 insurance companies who put it on their balance sheet. The insurance companies in the United States have $40 trillion balance sheet. The amount of money that we are able to front run legally as this capital comes into the space is gigantic. The RIA community, with its multiple trillions under management, they're just waiting for the ETF to get launched. When the ETF gets launched, they will pull the trigger too. So it's, for the first time in history, it's not the asset managers, the hedge funds and the banks front running us. It's us front running them.
Very well said. And someone that thus all of us in the know Plan B. And if you don't know who he is, go to Twitter, 100 trillion USD, and follow him. And of course, Raoul Pal as well. We'll get a little bit to that later. He was quoted today as saying for 1 year, for 5 years, and for 10 years, kind of what you just said, Bitcoin's been the number one performing asset. But here's the interesting one. 10 years ago, admittingly 10 years ago, if you put 1% in Bitcoin and 99% in cash, you would have outperformed the S&P 500. We will get to the risk of Bitcoin. I'm an investor, I'm an advocate, and they're absolutely legit risk. We will get to that, I promise. But what I tell families, and families have been a little slow here, is 1 to 3%. Worst case, it all goes to nothing. You live to fight another day. You're mitigating your risk. Here's a question I would like to ask you, because you know these people, the Joneses, the Drunken Millers, and so-called, these are not techies. They're somewhat older. So some people would say setting their views and how have they had a beginner's mindset. But here's my thing, and I'm based in Greenwich, so I get it. And I know you're going to feel the same way. Back in the 80s and 90s, before the trades got too crowded, these macro managers were crushing it. They weren't too big yet. There wasn't 10,000 hedge fund managers, the technology to see every little thing. And then what happens? Institutions get involved, especially ultra-conservative pensions, cutting massive checks, bigger than what 99% of single-family offices could cut. And they want to cut the you-know-what off the manager. They want to control the volatility, and then the manager gets billions, billions, and billions, and billions, and becomes super rich, good for them, and they become an asset gatherer. They don't become that swashbuckling trader. What they're doing now is saying, to hell with that, I'm already rich, forget the hedge fund, I'm going to close it. I got my own family office, and I'm going to invest the way I want to invest, and it's been great. What do you think?
That is, all the macro guys have realized that. That's why I left the industry back in 2004. I knew it was going to be destroyed because performance didn't matter. Also, alpha left the industry. There was too many people. There's more hedge fund managers than there were managers of Taco Bells. So what you've got is a situation there's no alpha. Then Dan Moorhead was the first to see it. He was from Tiger. Mm-hmm. Very, he was a good friend of mine and a very well-respected macro investor. He saw it. He just said, I'm giving up, I'm closing my macro fund, this is it. I don't know how long ago that was. It was like 8 years ago. It was a long time ago, 10 years ago. Next up was John Burbank. He saw it. Then it was, I don't know if John or Mike Novogratz. These are all my peers, colleagues, friends. Then it was Mark Yusko. Then it was all of the legends quietly in the background. Lewis Bacon, Alan Howard, all of these guys, they all got operations in this stuff. So one by one, they all infected themselves and it grew because they saw alpha. So let me explain what I mean. There is so little capital in this space in terms of the asset management part of the space that I know several crypto funds that are up 300% this year. Just the ones that track the index are up 150%. This is alpha that we dream of because there's not enough money in the space and the opportunities are huge. Then as the whole space, we see the rise of tokens, tokenization of real estate, tokenization of intellectual property, tokens of contracts, tokens of art, tokens of everything. The opportunities to invest are going to dwarf that of the equity markets in terms of number of opportunities, and the complexity is going to be huge. So it's going to mean there's alpha for a long time. So this, if you allocate anything, sure, buy some Bitcoin, find a few of these managers and a few VCs in the space and stick some money there and forget about it for 10 years. And you'll be very, very surprised how well it's done.
Would you say that even those that are off the record, so you don't have to name names, let's say you know hundreds of traders / macro managers, some of them absolutely billionaires plus, do practically all of them own privately, personally, without talking about it, gold and Bitcoin?
Yes.
Like 95% plus.
You have an inherent bias. So, Global Macro Investor, my research service, is read by most of the world's biggest macro hedge funds, sovereign wealth, blah, blah, blah. They're a bias because I've been writing about this since 2012. So a lot of them will own it because they know me. But my impression is everybody I know owns some. Nobody feels like they own enough. And none of them have it in their fund. Because they haven't been able to get prime broking or custody yet.
Yes. And those are things we could also get into. And we're going to have a series of significant deep dives starting from ground zero to something in Bitcoin and crypto over the next month for my members. And again, I know I've immersed myself in it. I've done it. I've invested. I've been hurt. I've had successes. So, some things to talk about there. There's other amazing investors that you didn't even mention to add to the list have been vocal proponents of Bitcoin. Bill Miller, Kathy Wood, who's incredible. She's great. And someone I know is a great trader. I'm talking with him tomorrow and hopefully he'll be on in a month. Dan Tapiero used to work for Steve Cohen. I mean, that's what you're saying. Look at this groundswell. Now, I'm assuming you're in the know. I'm a little bit in the know, but I don't know as much about some of the family offices on the line. I've been a little bit skeptical. Michael Saylor is the CEO of a public company. Again, a public company. He put approximately 450 million. You heard that right. Not 1,000, 450 million very publicly. So he's out there very public about it. Well, it is a public company into Bitcoin. And I don't think he's going to stop. Square has some money in Bitcoin.
By the way, he just issued a convertible bond yesterday.
I saw that. Unbelievable.
To invest another 550 million in Bitcoin. He's going to have $1 billion of Bitcoin on his balance sheet.
Yeah, I'm almost wondering if I invest in MicroStrategy, am I getting Bitcoin and ETF-like exposure?
Well, exactly. That's what it looks like.
That's probably the point. And we didn't even get into a lot of people of a little bit more maybe old guard respect someone like Neil Ferguson, the legendary historian who's been incredibly very positive in his writing. BlackRock and Guggenheim kind of kicking the tire. And eventually, yes, and probably BlackRock may be the one eventually when an ETF comes out. The RIAs will be able to offer it to their clients. It's going to really be a tremendous boon. And we're going to get, I promised, to some of the challenges. So why do you think, Raoul, and I have my opinion, and it does offend some people, so I'll try to be a little kind about it. Still, among the over 50 that are not macro and traders, that are wealth creators and family office CIOs, they became familiar with it. They were a little scared away when it crashed to a degree in 2017. I think the number of families that I know, and maybe I know ultra conservative families that have an allocation of more than 1% to Bitcoin, I don't think it's more than 3 to 5% of them. They're just, why? Why is this?
Because it takes a while to understand. It is counteracted by sloppy journalism. It's one of the reasons why at Real Vision we spent time to look at this space properly by inviting the world's smartest people to talk to us about it. The journalists kind of echo the establishment, and the establishment was scared of this. It's hard for family offices to learn how to deal with a bearer asset that's not real estate or gold. Everyone's used to sticking gold in a vault and real estate they own, but nobody's used to owning share certificates or anything else in bearer asset form. So it's a little bit daunting. The space itself came out of technology, so people speak a different language, but that will change. And the time to take risk is before everybody else understands it. People fear government reaction, but if you actually spend the time to look what governments are doing, they're trying to regulate it to make it more accessible to everybody. i.e. family offices, pension funds, and everybody else who wants to put capital at work safely. So it's all coming and it's all in place. Just remember, most narratives you get to hear are previous narratives. They're delayed narratives. They're not the narratives of now. The narrative of now is, as you said, Angelo, it's actually massive allocation of capital by some of the world's most respected firms. This is not gunslinging hedge fund managers. This is insurance companies now. That is a game changer. So the fears of hacking, blah, 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 that's all gone. That's an old narrative. The fear of regulation. Yes, it will be regulated and you'll be happy that it is, because it's going to go up in price because it means that more people can come into the space because they feel comfortable. So what are the other fears we hear? Quantum computing, they're going to hack it. Well, that's been slightly discredited because we're nowhere near that taking place. And also the fact that people are already building quantum protection because the Bitcoin community is ludicrously smart. And we haven't even talked about the Ethereum groups and all of the other parts of this blockchain.
Assuming we have the time and even DeFi and stuff like that.
So there is a huge amount here that everybody is behind the narrative on. I mean, I managed to get one of my clients who's a very famous Italian industrialist, family office. He's 86. I've got him to trade Bitcoin now. He gets it. He kind of gets it.
You performed a miracle. A little bit on that note, I think the statistics show that 3% of baby boomers and older have experience or own Bitcoin. And I think it's about 38, 39% of millennials. And therefore, to me, since the older people often control the money, that's been a little bit of the issue. I interviewed an older billionaire. Actually, it was about that same time, November of 2017 on stage. I asked him about Bitcoin and he poo-pooed it. And I'm thinking he's a real estate guy, very traditional, owns banks, and he's way more successful than I'll ever be. But the amount of research that he put into Bitcoin, it's zero. His CIO is also in his 60s, early 70s. This is, and I understand, I'm not a spring chicken. I'm in my mid 50s. This is a little bit of read Satoshi's paper, do the diligence, do the research, read the Tudor Jones, see what Michael Saylor's doing, subscribe to what, Raoul's doing, become educated. I think if you put in 15 to 20 hours, that's all I'm asking for, you'll be able to make an educated decision. And that decision may be no, but that's okay. You put in the work and you have a thesis and your decision was no. Question for you, Raoul, because people are going to ask, you're talking very positively about Bitcoin. Are you putting your money where your mouth is? To start 2020, how much of your allocation of your liquid net worth was in Bitcoin and how much now?
I don't know what it was at the beginning of the year, but I would say of my liquid net worth. So this is the investable capital. This is not my private, my ownership in private businesses, not my real estate. It's the liquid money of which to invest or spend or save. I would say at the beginning of the year, I was probably around 25%. And I was trading more, taking advantage of the bond market, stuff like that, because I saw the big opportunities. By April, May, Bitcoin sold off. I was probably up at 50% because of the money printing and the response of, okay, I can see how big a deal this is, COVID and the central bank responses and how long it's going to go on for. Then by about August, I was 75%, basically 75% Bitcoin, 25% gold. Then 3 weeks ago, I went to 0 gold.
Wow.
2% in call options on bonds, and 98% split between Bitcoin and Ethereum, split 80-20.
Oh, wow. 98% of your liquid net worth. You are putting your money where your mouth is. That's, when does
I'm a macro guy. I cannot express, I can be wrong, but you never, ever in your career see such a big asymmetric risk reward in your life. You will never see it again of any sort in an asset. You'll see it in an individual equity, but they carry more risk. Here is an asset that follows Metcalfe's law. If you don't know what Metcalfe's law is, I urge everybody to read about it. It's the network adoption effect that made Facebook so big. This is something unique.
I promise probably to wrap up in the next 15 minutes, but I do want to ask one more thing on Bitcoin, then maybe we'll switch to Ether, DeFi, stable coins, et cetera. It's only fair, you brought up one of them, that we discuss some of the challenges potentially to Bitcoin. Yes, quantum potentially is one, probably 5 to 15 years away. The industry is already working on it. And by the way, the centralized networks that the banks use, where there's way, way more money in your stocks and your cash, that's going to be the much easier target for quantum. Imagine your stocks disappearing from Ameritrade, cash. Now, I think the industry will prepare for it. Maybe they'll go on a blockchain, et cetera, but that's going to be more of a risk. Although admittingly, quantum could be an issue. What's my biggest risk? I would say it's two. I would say a lot of the miners are in China, and the government nationalizing the miners and controlling the hash power. Let's not get too techie for most of the audience, but you get it. And effectively doing a 51% attack. And my big one is basically the US or other governments, the IMF, banding together, legal or not. And I know they can't get rid of it because it's the internet and one day in satellite, but to make it illegal to have exchanges here, I think realistically, the cat's out of the bag. They'll tax it and they'll make money. But what do you think?
Yeah, look, I think they'll tax it, make money, own the on-ramps and off-ramps. So you can hide it around the system, but if you want to spend it, same with gold, right? If you have to bring your money into the system, you're gonna have to pay tax on it. That's okay. Move to the Cayman Islands if it doesn't suit you. And so, yes, I think that's a risk. China, the 51% attack, why would they do it? Because the moment you attack Bitcoin's network, it goes to zero. So they basically don't have any money. Now, Chinese are one of the biggest users of Bitcoin. So that's one. Game theory suggests hugely unlikely. Secondly, there's a bunch of people rolling out very cheap energy input mining in the US. So I think it's Peter Thiel is doing it in Texas with gas flaring. It's free electricity.
Yes. Yep.
It's going to come all over the place. We'll see it in Canada, where you've got the cold weather and free electricity, basically, because the energy gas burns. So I think that 51% will become deconcentrated. I think it will be a sovereign mission for every nation to have a stake in this ecosystem. And I think they'll purposely incentivize it.
Let's try to buzz through a couple of related topics a little quickly. You mentioned besides Bitcoin, the number two is Ether and broadly the Ethereum blockchain, which is amazing for smart contracts and really may be the infrastructure or backbone, some would argue, for DeFi. And eventually, I think the next Amazon is going to spring from that. So you're hedging your bets, I would say, a little bit from not being all in on Bitcoin to also having exposure to Ether. Why?
Because think of one as the vertical, which is the world's best reserve asset. Bitcoin owns that. Nobody's going to take that away. What Ethereum is a platform. It is a new technology platform where you can create programmable smart contracts that is based around an incentive system of a token, which has a store of value implicit within it. It is extraordinarily powerful. I think Ethereum is going to outperform Bitcoin because the sheer amount of brain power that's going towards developing on that protocol is gigantic. The rise of DeFi, decentralized finance, is just one of them. The gaming industry is another. Visa is another. So it is a very well proven technology that is scalable, is fast, and is effective. So I think of one as an ecosystem and one as an asset.
And I mean, this could be a little bit of a complicated one, so we'll throw it out there anyway. This is going to get rid of banks, and if government's central bank currency, they won't need it. The middleman, yeah, there'll be some consolidation, but I look at JP Morgan has adapted well. Citi's talking about developing currencies for governments. Goldman, your old firm, is very creative. These are influential firms. They're influential from a political perspective, from a monetary perspective, and they do many things. They will not go away. They will find a way to work in many ways with custody of crypto, stable coins coming out on the Ethereum network, all of that. I think they're going to be more adaptable than the average person who's in our community thinks they're going to be. What do you think?
I think the leading firms have a massive pooling of intellectual capital. They understand. I think it's going to entirely hole out all of the middle tier money market banks. They won't need to exist. So I think across the world, the whole middle tier of money center banks, they're gone. But it won't happen overnight. It'll happen slowly and then all at once.
I believe I heard you quoted, if I have it a little bit wrong, but let me read it and then you could correct it and give an answer. Family offices use gold as a base, and then they invest in currency plays and global markets for arbitrage. If you could discuss that and how that's evolving relative to the things we're talking about, especially with Bitcoin and digital innovation.
Look, I mean, everybody has a different way of doing things. I think a base layer for family offices should be gold and Bitcoin. Gold has its proven storage, its proven store of value. Bitcoin has the proven store of value and upside. It's a nice combination. And then around that, you can take more risk in areas that you want, whether you're allocating to emerging markets or allocating to direct equity or, you know, VC, some of that stuff. It's very interesting. You know, or whether it's allocating it to hedge fund managers who are undertaking arbitrage. There's lots that can be done. I just like the base layer of everybody's portfolio to be gold and Bitcoin.
And Raoul, I think I'm down to my final three questions, so we'll punch them out. It's a complex one. We both hinted at it earlier. We probably need to do a completely separate podcast about it. But the potential, and admittingly it's potential, the potential of DeFi, decentralized finance.
Well, think of the digital architecture of the financial system being Ethereum. Think of the collateral of the system being Bitcoin. You can already pass Bitcoin across the Ethereum network by wrapping it. So these things you can move around now. So you're moving a reserve asset onto the financial platform. So, okay, we've got the platform where these tokens exist and they move around and trade and can be created. But what you need is the applications on top. The applications on top are things like DeFi. And they're small code-based businesses that develop algorithms around the lending and borrowing of tokens. And that generates a yield. So this is the nascent start of a digital financial system. We've got the two most important layers in place. This is the layer that ends up being the thing that we use and we won't even notice it because it'll just be on a smartphone.
Yeah. Completely agree. This is amazing times that we're living through. Just look about the last 30, 35 years, the internet and effectively crypto, blockchain, and what's coming with tokenization, DeFi. It's an amazing time. A little scary, but potentially, let's be optimistic and say fun as well. What resources do you read, watch, or listen to that's kind of your go-to?
Look, I'm very, very lucky in being the co-founder of Real Vision. I get to spend all day speaking to the world's best investors and analysts and strategists. So if people don't know of Real Vision, go to realvision.com. It's extraordinary. There's also tons of free crypto content. But if you want to hear from Stan Druckenmiller, so I'm a big fan of what we've built. I use financial Twitter as you do, because we get a lot of different people that we get to meet, hear lots of different opinions. It can sometimes be overwhelming, but it's actually very valuable. I'm still a big fan of reading the FT and the Financial Times. It's just an extremely high quality paper. And then I listen to a few podcasts here and there, but that's it. I mean, I use my Bloomberg terminal. I look at a lot of charts. I spend time charting. And then I can see, oh, is that interesting? What's going on with emerging markets? Now I need to do some research. Then I'll start Googling it. Doing your own research and not being told what to do is the single most empowering thing you can possibly do.
What I sometimes hear from older family office principals or executives is, yeah, okay, I'm in my late 60s, 70s. And I'm like, yeah, do you see what's happening with biotech, health, and medicine? Do you listen to Peter Diamandis, Ray Kurzweil? Do you know what's going on? You may live to be 120, 130. And then Wright's Law of genomics might even expand that further. If you miss out on what's happening now because you think you got 5 or 10 years left, it's gonna, some of you are spending more than 5% of your capital every year, which is a little bit risky. You need wealth preservation. Part of wealth preservation is growth. I think they're kind of missing out. Okay, the really, really important question of the day. What's your favorite rum?
It depends for what occasion. If it's my everyday drinking go-to rum that I can mix it with rum and Coke, or I can have it straight on the rocks, it's Flor de Caña 12 years from Nicaragua. If it is my top shelf special rum, it's Clement from Martinique. Clement Honor from Martinique is my favorite rum. If it's a top shelf, not going to make me wince when I buy it, it's probably Zacapa XO from Guatemala. And I love the fact all these rums come from all these exotic countries, right? It's part of the fun of rum is like swapping which country they're from. Have you tried this rum agricole from Martinique? Is it as good as the one from, somewhere else? So it's great. So those are my favorite rums, my go-to rums.
I mean, I said it jokingly a little bit earlier, but for families that have a passion about it, and it ends up being their version of old-fashioned gold, but art, watches, fine wine, is there some validity to it as a hedge, an investment hedge?
Very much so. And actually, we just made a program. Somebody was a Real Vision fan, reached out to me and said they are the family who owns Dictador Rum. And Dictador Rum is from, I think, Colombia. And they said, listen, can you make a video about rum as the new whiskey or wine? because it's actually happening, because rum is taking off and people are realizing its value, aged rums. And so we made them a whole series about collectible assets, of which rum was one of them. And they paid us in a case of their finest, not a case, a barrel of their finest rum.
So as opposed to drinking it, you can hold it for 50 years.
Exactly.
It's a store of value. Well, this was great. So realvision.com, which I highly recommend. Now, I will ask you, with the great macro work that you do and people hearing this, and if I was a single family office, I would say, yeah, I'll subscribe to Real Vision, but I want to get to know Raoul. Can I have him on my investment committee? Does he consult? Do you do any more advanced work with select families?
Yes. Global Macro Investor is a pretty elite, not very cheap research service that my largest client base now is actually family offices.
And do they have access to you directly?
They do. And I also do consulting. So the Italian family office I was talking to before, I have several family offices around the world that I do direct consulting, but they have to be Global Macro Investor members before I do that.
I understand. That makes all the sense in the world. I am going to
find it on the website, globalmacroinvestor.com. You can check it out there, and there's a contact details there.
Raoul Pal, I mean, this has been amazing. It's been a great pleasure. It's great to get to know you a little bit. I love the Caribbean. I've been to almost every country there. Fave is St. Bart's, but I've not been to the Cayman Islands. So hopefully one day soon I'll be able to change that. I do a close. It takes about 2 minutes. Your schedule's very tight. Please feel free to pop off. I'll finish up my close, but it's been tremendous to get to know you. Thank you so much.
Yeah, great to see you too. Thanks ever so much. And I hope everybody found it useful.
Thank you. And everyone, I'm Angelo Robles. I'm the host of the Angelo Robles Podcast and the founder and CEO at Family Office Association. We're a global membership organization, just like Raoul, some of the work that he does, dedicated to families of great wealth, both the families and directly their single family office executives. We do a significant amount of original proprietary research, written white papers, interviews, podcasting, books, etc. I'd like to hope that I or we, as an organization, have a deep Rolodex and try to connect the dots, I guess you could say, for our families as well. We host events, and I used to say we haven't done it since COVID, and I've interviewed from Ray Dalio to Tony Robbins and Tudor Jones and many others, but I did host a little workshop in Miami. So even during COVID, we're going to be a little bit strategic and selective, but some families noted in small settings with very careful protocols, could I still occasionally do some workshops? And I have. We also consult the families on creating a family office, and we've been incredibly active. I've dived immersively into it relative to Bitcoin, crypto, DeFi, tokenization. We have so much more of content and then some specifically for our members. I recommend our social media platforms. Subscribe to us on YouTube. Simply we're Family Office or Family Office Channel. You'll find me. And the website, which has been updated relatively recently, I think it's beautiful. Hopefully it helps. FamilyOfficeAssociation.com. And my direct email is angelo@FamilyOfficeAssociation.com. We encourage you to learn more, inquire into membership. Thank you so much.